Good morning, everyone. So we have another Sunday to spend time together on Ind AS 33 today. That is earnings per share. We did a bit of EPS yesterday where we saw the fundamentals. We saw what we mean by basic EPS. We also saw the fact that the number of shares is weighted on the basis of time. So we did a couple of computations on weighted average number of equity shares. We also saw what it means by the numerator net profit attributable to equity shareholders. And we did a couple of basic EPS questions. And after that, we also saw the bonus issue. What happens in the case of bonus issue? We have to do a restatement of the previous reported EPS, which is the comparative one basically, because bonus shares are already in existence in the capital structure of the entity, although they do not give me they are not visible, but they are present in the forms of reserves and surplus, okay, or other equity, as we say in the Ind AS regime. So basically, bonus is capitalization of reserves. So these reserves end up getting capitalized on a future date, but they are present in the capital structure. So you are having your bonus shares present right from the beginning of the earliest reporting period. So they are deemed to be there. So therefore, we do something known as a bonus adjustment factor, which is basically pre plus post bonus, the number of shares on the numerator divided by pre-bonus. So that is the bonus ratio or the bonus adjustment factor, which we multiply to all the periods prior to the issue of bonus shares. Bonus shares के बाद तो it is a regular calculation after the issue of bonus shares. So this calculation is mandatory, which we have to do. Then we saw rights issue. Rights issue is essentially an issue of shares made to existing shareholders, typically at a discount. The discount is leading to the conclusion that, sir, we are issuing a bonus share, but it is not in terms of the bonus shares as we contemplated in the bonus issue. This is because my rights issue is at a price lower than the fair value. So there is a bonus component. So we saw how exactly to solve this particular question. We did the longer way first, where we determined what is the number of bonus shares which are issued. And the number of bonus shares issued is essentially going to be considered in the current as well as the previous period. And the shares at fair value are regarded as a regular fresh issue, and we do the computation accordingly. However, there is an alternative method also, which we saw yesterday, where we compute something known as the rights adjustment factor. So what is the rights adjustment factor? It is basically the theoretical price of the share. So you can have a look. It is fair value immediately before the rights issue, divided by theoretical X rights price. So that gives me the rights adjustment factor. Then we apply the rights adjustment factor to all the periods immediately prior to the issue of the rights. And then we determine the weighted average number of equity shares. So that was what we used to do for the rights. So I hope that the rights issue is clear to everyone. Good morning, Shankar, Yadu, Shailesh, Mohammed, Shruti, Tanisha, good morning, good morning. Okay. So now coming to, I had told you that I will be taking you through, the one of the practical rights issue that had happened somewhere in 2020-21. This is of a company known as EIH Limited. Okay, EIH Limited is essentially your Oberoi Group, which runs these Oberoi hotels across the globe. So all this Amar Villas, Uday Villas, this is the company that is looking after, that is this, which is their operations. Okay. So now let us look at the year 2020, 2019-20 first. Okay. Let us look at the year 2019. I'll quickly run you through this. There is not much that we need to look at from a computational perspective, But how it happens practically, we'll just quickly run through. Okay. So in the year 1920, this was the previous year. The rights issue happened in 2021. So we'll just have a look at the prior year. And when we look at the prior year, we will understand what was the reported EPS. And based on the reported EPS, we'll then come to the current year where the rights issue has happened. The rights issue, we will look at the terms of the rights issue, the issue price, and then we will take you through the X rights price, etc., all that we are going to have a look right now. Okay. So this was the previous reporting period. Okay. For the purposes of rights issue. So how do I get it is my profit attributable to equity holders is 1244.67. This essentially comes from the profit and loss account. Okay, so you can have a look here. I have the P and L. I have the P and L on page 120. Okay, so here profit for the year 1244.67. You will not be considering items in the other comprehensive income for the purposes of EPS. Okay, it will be only the profit and loss. Okay, the first part. So 1244.67. So we move to our page number. I suppose it was 171. Yes. So 1244.67 profit attributable to equity shareholders for basic as well as diluted. We'll see diluted a little later during the course of today's discussion. These are the number of shares which are used in the denominator. Okay, the weighted average number of equity shares. So this also will be there in the capital structure where you have the note on equity reconciliation. Okay, so just let me open that for you. Revenue from operations. This one. Just give me a minute. Okay, so you are having your equity share capital 571, 569, 414. So 571.569 million is the number of equity shares that are in issue. Okay, so with this, we are having the basic EPS that is getting computed. Straightforward calculation, quite similar to what we did yesterday when you computed 2.2. So basic EPS 1244.67 divided by 571.569 million. Okay. So now if you look, I have just prepared a summary working. So this is my reported EPS. Net profit attributable to equity divided by weighted average number of equity shares. So that gives you a basic EPS of 2.18. We now come to the financial year 2021. We now come to the financial year 2021. I hope you can see the raising of capital by rights issue. Okay. There is a raising of capital by rights issue that has happened. They have given that the company has raised capital by issue of further shares to eligible equity shareholders on rights basis in the ratio of 8 shares for every 85 shares held. So this is the rights ratio. In our yesterday's problem, it was 1 share for every 5 shares held. Here it is 8 shares for every 85 shares held. The shares are issued at a price of 65 rupees per share. The share had a face value of 2. Issue price is 65. So the premium is 63 rupees per share. The company issued these many number of shares, 53, 794, 768. You can quickly have a check. It is nothing but these many number of shares. Okay. This is how many crores it is? 57 crore 15 lakh shares multiplied by 8 by 85 gives you 5 crore 37 lakh 94,768 shares. Okay. So straightforward calculation on that. The company issued these many shares aggregating to this much million rupees. Okay. And then they give the reason why it was issued. They give the reason why it was issued and when was the trading permission acquired from these stock exchanges. Okay, so are we clear with the rights issue? Issue price is 65, 8 shares for 85 shares. Okay, page number 63 is what we saw. Now, if you look at the rights issue timetable, okay, the rights issue timetable, the rights offer opened on 29th September 2020 when the market price was 81.85. The rights offer closes on 13th October 2020 when the market price was 76.2. Allotment date is given to be 20th October. Record date is 23rd September and the date immediately prior to that is 22nd September. So these are the various market prices which I have taken from the data, okay, which I have taken from the company's share pricing data, okay. So this is my rights issue timetable that had happened. Record date is the date when the allotment of shares starts getting decided. That is the date when you look at the members register and basis that the right shares will go to that particular individual whose name exists on the record date. Okay. Now coming to the rights issue subscription, a straightforward entry, bank account debit to equity share capital 5.38 crores multiplied by 2 to securities premium multiplied by 63. So if you recollect, this was the capital raised which was given in the explanatory statement we saw on page number 63. 34,966. What you can say lakhs. Okay. This is the money they raised, about 350 crore rupees. Now, allotment happened on 20th October 2020. Okay. Now, we look at the theoretical procedure, how we solve. Theoretical procedure, how we solve. We calculate, first of all, the theoretical X rights fair value or theoretical X rights price. So, for that purpose, in our example, the theoretical X rights price is nothing but number of shares into existing fair value. What is the existing fair value? Well, we look at the fair value immediately before the offer closes. That is, as on the date the offer closes, the market price was 76.2. That is the price we are going to look at it. You can look at our words which we are using. Fair value per share before the rights. That means before the rights closure, this is the fair value. So this value contains two components as we saw yesterday. The value of the share plus the topping on that in the form of the rights. So therefore, in our example, that date is 13th October and the market price was 76.2. So theoretical X rights price 85 into 76.2 plus new shares issued 8 shares into 65 divided by 85 plus 8. So you get an X rights price of 75.24. So the rights adjustment factor is going to be 76.2 divided by 75.24. So that is 1.01. That is 1.01. Okay. Now, you can also look at something extra what we did. When I saw what was the bonus component, in our example, it was 37,838. Let us look how it is here. We have this proceeds which is collected 34,966. X rights price is 75.24. In yesterday's example also, we saw that, yes, we divided by 30.833 if you recollect. Here that 30.833 equivalent is 75.24. So the number of shares at fair value is actually 4.65 crores. But you have issued 5.38 crores. So basically the bonus element in your computation is 73,19,225. It is as if though you issued 5.38 crores, essentially the free shares is 73 lakhs and the balance shares at full consideration is 4.65 crores. Okay. So now coming to the working, Right share working works something like this. You are having the rights adjustment factor. You are having the number of, you are having the period. Okay. So now if, sorry, not this one. Why did I take this? Okay. iPad. You are having number of shares, you are having rights adjustment factor, and you are having the period from 1st April to 19th October. So therefore, 19th October you can see in the facts case. Okay, 19th October is the allotment date. That is the rights offer closing. Immediate 13th allotment date is 20th. Immediately before that, that is till 19th October, we are considering the original shares which were in issue. So therefore, 5715.69 multiplied by rights adjustment factor multiplied by 202 divided by 365 gives you the weighted average number for the first block. The second block after the rights issue, straightforward, there is no dispute. So you will be having 6253.64 multiplied by 163 by 365. So that gives you the weighted average number of equity shares. So if you now look at the share, if you now look at the current year, that is 2021, when you did the issue, you should be getting a basic EPS of minus 5.72. If you recollect, 2021 was the COVID year when all the resorts essentially were not operating. So it went into a huge loss immediately after the rights subscription. Okay. So therefore, if I look at the data here, and if I go to my 2021 and I open the profit and loss account, you should be able to capture the standalone EPS. Okay, 5.72 versus 2.15. Now, the reader of financial statements saw that it was 2.18 originally, if you recollect. But here it is 2.15. So, therefore, a further explanation needs to be done. There is a restatement of EPS that has happened here. So, this restatement of EPS, we just run through it quickly and then we are done with our question on rights issue. Okay. So that where it is, these are all big notes. 4850. Okay. So here you are having your EPS. Okay. So previous 1244.67 and the number of shares here has undergone a change. The number of shares here has undergone a change. It was 571.69 earlier. Here it is 578.888. That bonus element, 73 lakh shares, is what is added here, which was the same like what we did yesterday. 10 lakh plus 37,838 shares if you are able to recollect. Okay. And 599,643 is your current, what you can say, denominator that they have considered. Okay. So therefore, this is how you are going to do it. Okay. Considering it for time. So 599,643,471. So your basic, what you can say, your current period's basic EPS and the restated EPS of 2.15. The restated EPS of 2.15. Are we clear with rights issue? Yes. This one thing, you can just keep it for your reference. Okay. You want, you can try it out by yourself. You can pick up any other company which came out with a rights issue and then you can try to do the working by yourself. Okay. You should be in a position to get the answer. Okay. Or you to get the basic EPS. Is it okay? Yes. Any doubts? Anybody so far? Rights issue fully clear? Yes. Okay, fine. So that takes care of what I had to explain yesterday to all of you. So I hope you did those couple of questions. One question I had asked you to do. I hope you did that particular question. Okay. Question number 13. If you have not done it, please try it. because it's nothing new. It's the same thing what we have been discussing. Okay. So that concludes my discussion on the rights issue. Okay. And then I had also asked you to look at buyback. I'm not sure if you have seen the buyback. I'll come to buyback a little later because it's not so important as the other concepts which I have to discuss. So we visit the buyback issue a little down the line. Okay. So till now, we have done essentially what you have already studied. Okay. We have done basic EPS, bonus, and rights. We have not done anything new or anything fresh from an India's perspective. Now, let us come to to some of the concepts which are peculiar to Indians. We come to some concepts which are peculiar to Indians. Okay. Now, I know that you people have not studied financial instruments. Okay. I know that you people have not yet studied financial instruments, but I will run you through some of the concepts. Okay, as a part of discussion for the purposes of EPS, and then we shall look into certain questions to get our further clarity. Okay. Now, so far we have been focusing on the denominator. So far we have been focusing on the denominator. Now we come to the numerator. Now we come to the numerator. Okay. Sir, do we have any adjustments to the numerator? What is the numerator? Sir, numerator is nothing but net profit attributable to equity shareholders. So when I talk about net profit attributable to equity shareholders, my P&L contains net profit after tax. Is that the net profit attributable to equity shareholders? Answer is not necessarily. It could be different. It could be separate. Okay. So therefore, we look at the adjustments that could possibly exist in the case of the numerator. Okay. So first one, under your AS regime, how did you calculate? Sir, this was nothing but net profit after tax as per the P&L minus preference dividend. Minus preference dividend. Do you recollect doing this? Yes. Do you recollect doing this? This was net profit attributable to equity shareholders. ऐसे ही कुछ करते थे आप. You used to do something like this. Okay. Now, further, cumulative, non-cumulative, deduct every year. We saw this yesterday. Declared or not. Declared or not. Whereas non-cumulative, deduct only if declared in reporting period. Deduct only if declared in reporting period. So this was the treatment under AS regime. Now we come to the Ind AS regime. Now we come to the Ind AS regime. Sir, इसमें क्या अलग है? इसमें बहुत अलग है. There is a lot of difference in this treatment. Okay. Now, under Ind AS, your preference shares depend on the classification of preference shares could be as equity or it could be as a financial liability. Okay. It could be equity, it could be financial liability. See, what are the characteristics of preference shares? If I go by the Companies Act definition, preference share capital should be mandatorily redeemable and maximum tenure you can carry preference capital is 20 years. Correct. That's right. And typically, preference shares come with a fixed rate of dividend. They come with a fixed rate of dividend. 8% preference shares, 10% preference shares. Okay. Now, I don't have a problem with that. But if you look at the feature of the preference share, if you look at the feature of the preference share, one is you are paying a fixed dividend, say 8%. Second is you are mandatorily redeeming the preference share. That means you are repaying back the preference shareholders. So what are you doing? You are under an obligation. You are under an obligation to deliver cash for the preference dividend. You are also under an obligation to deliver cash for the principal amount that you have taken at the end of whatever 15, 20 years, whatever is there. So essentially, you don't have an option. You don't have an option. And if you don't have an option, then this being an obligation to deliver cash for both the streams, that is the finance cost or the dividend as well as the principal, this is nothing but a financial liability. This is nothing but a financial liability. Sir, but उसको हम बुलाते हैं preference shares. Now we used to call it as preference shares. Sir, you used to call it preference shares. That is a name, sir. You are giving a name to that. But go behind the name. Look at the substance. Sir, preference, you बचपन से सीखते आ रहे हो preference share capital has a priority over equity. At the time of liquidation, the preference shareholders claims will be paid off first. Arey, what does it mean? You are basically treating them as a loan. They are essentially a loan. They may be named as preference shares, but fact is they are nothing but a borrowing. They are nothing but a financial liability, and therefore the coupon which you give, the preference dividend which you give, is nothing but the finance cost. Is nothing but the finance cost. So therefore, when I talk about preference shares, when I talk about preference shares, one is mandatory payment of preference dividend and redemption of preference shares in cash. What is this? Obligation. You can note this down side by side, okay? Obligation. Yukta is not there today. Obligation to deliver cash. So therefore, this becomes a financial liability. This becomes a financial liability. And because it becomes a financial liability, the preference dividend is nothing but the finance cost. Implications are important, sir. थियरी समझने से कुछ नहीं होगा. Implication समझो. Preference dividend is finance cost. But sir, finance cost is a charge against profits. वही तो. That is exactly what is happening now. Finance cost being a charge against profit already considered in net profit after tax. Net profit after tax. And if it is already considered in the net profit after tax, do you have to deduct the preference dividend again after net profit after tax? Do you need to do this? No, sir. एनपीएटी में वो फाइनेंस कॉस्ट में ऑलरेडी है. इट्स ऑलरेडी अ पार्ट ऑफ द फाइनेंस कॉस्ट विच इज डिडक्टेड व्हेन I determine my net profit after tax, and therefore no further adjustment required for preference. Oh, good, you are there. Okay, good. Okay, so no further adjustment required for preference dividend. Are we clear with this? With this part, are we clear with this? Yes. Are we clear with this? Anybody has any doubts? Anybody has any doubts here? Yes, all clear. So if my preference shares are classified as a financial liability, the question will tell you the preference shares are treated as a financial liability. Do you need to deduct preference shares separately? Answer is no. It's already forming part of finance cost. You will not be deducting it separately. Okay. Now, suppose we have a second category of preference shares, what we call as irredeemable preference shares. Now in India we cannot issue these instruments, but we are not studying Companies Act, we are studying India's. So suppose we call it as irredeemable preference shares with discretionary dividend. With discretionary dividend. That's right, Mohammed. That's right. In financial statements, there won't be something like preference dividend. It will be a part of your finance cost. When you study your financial instruments chapter, that time you will understand. Basically, the very definition of financial liability is a contract. It is a contractual obligation to deliver cash. Okay. So you will be having one is plain equity instruments where you don't have any obligation to deliver cash. It is a residual interest in the assets of the entity after deducting all the liabilities. The other side, you are having financial assets which represents a right to receive cash, okay, or exchange instruments on favorable terms to the entity, which is basically an option with a favorable condition attached to it. And on the other side, you are having a financial liability, which is an obligation to deliver cash, a contractual obligation at that. So therefore, all your trade payables, your borrowings, preference shares required to be paid in cash, everything goes under financial liabilities. Okay. So therefore, financial liability means there will be a finance cost attached to it. So though we call it as preference dividend, वो dividend नहीं है. It is a finance cost. डिविडेंड होता देयर वुड बी वेरिएशंस इन द डिविडेंड, बट यहाँ पे तो वेरिएशन नहीं है सर. इट्स वन स्ट्रेट डिविडेंड रेट व्हिच इज अप्लाइड टू ऑल द इयर्स. सो इट इज अ बोरोइंग कॉस्ट. It's just that the name is different. So this preference dividend also will go and sit under finance costs in the financial statements. That is why no further adjustment is required. Coming to irredeemable preference shares with discretionary dividend. Irredeemable means what? At the time of liquidation, whatever has to go will go to the preference shareholders. That's it. That is the meaning of irredeemable. उसके पहले, prior to liquidation, you are not going to pay anything to them. You are not under an obligation to deliver the cash for the principal amount. With discretionary dividend, किसके discretion? Discretion of the company. Company does not have cash. It says will not pay the dividend. It's discretion. Okay, so these are basically your non-cumulative preferences. Non-cumulative preferences. When I say discretionary dividend, they would be your non-cumulative preferences, and they are irredeemable. So now you tell me, is there an obligation to deliver cash? Answer is no. No obligation to deliver cash. And because there is no obligation to deliver the cash, this would go and sit under equity. This would go and sit under equity. If it sits under equity, and sometimes suppose the company declares the preference dividend and pays it off. Okay. It declares in between, in 1 or 2 of the years, it declares preference dividend. Will this preference dividend go to finance cost? Answer is no, because your instrument is not a liability, it is actually equity. So equity payment to equity holders will form a part of reserves, it will not form a part of the profit and loss. And therefore, preference dividend is not finance cost, hence not considered in net profit after tax. Therefore, deduct preference dividend from net profit after tax to arrive at net profit attributable to equity shareholders. Are we clear with this? Yes, am I totally clear with this? No doubts? Any doubts? No doubts? Yes. Are we clear with this? Okay. Any other doubts? Anybody? Tanisha has confirmed. What about Shruti? What about Yukta? What about Shankar, Yadu, Mohammed? What about you? What about Viraj? Are you clear? Yes? Okay? All right. Fine. Okay. So that takes care of preference dividend. Preference dividend, the treatment is clear. Okay. Now we come to another concept. Okay. Related to preference dividend, preference share only. Okay. Premium paid on early redemption or conversion of preference shares. Premium paid on early redemption or conversion of preference shares. Okay. You can give the heading. You can give the heading. Okay. Okay. All right. Okay. So now let us start. Okay, so now this essentially depends on two factors. One is preference shares classified as equity. One is preference shares classified as equity, and the other is preference shares classified as liability. Preference shares classified as liability. Okay. So let us just understand. I'll not do any calculation, but I will use some figures, and then I will make you to understand how it happens when preference shares is classified as a liability, and uh, what adjustment would be required or not required at that point of time. Okay, so we just have a look at it. Okay, the institute has made a change in the solution. You had a similar question, you had the same question in the earlier editions. I'll open that content also for you. So in that content, the solution is slightly different. Here, the solution is slightly different. So therefore, we are going to have a discussion on that as well. So those of you who are having the earlier version of the textbooks, you will have to make a change in that. Okay. But let us first understand. Let us first understand. Okay. See, for a shareholder, for a shareholder, okay, I'll come to your question later, Tanisha. Let me first explain the whole process. Let me first explain the whole process. Then you can understand it better. Then you can understand it better. Okay. See, let me take one example for you. Okay. Let me take one example for you. You tell me whether it is going to be a discount or a premium. Okay. You can tell me that. You have taken, this is separate apart from that. I'll come back to this later. Okay. I take a 25-year housing loan from HDFC. Okay. I take a 25-year housing loan from HDFC. मैंने घर खरीदा. I purchased a house worth 2 crore rupees. I did a down payment of 50 lakhs. Loan taken is 1.5 crores. Okay. 25 years, I will pay the EMI. So the EMI will come something like 1 and 1.5 crores, right? So that will be somewhere like about 2 lakhs per month. Now, I got a sudden jump in my career. I moved abroad. I have so much of money with me every month that now I can afford to prepay this loan. So when my EMI is 2 lakh per month, I can afford to pay 10 lakh per month, and therefore I go for the option to pay 10 lakhs per month. Okay. I will repay the loan immediately, and then I get my promotions. I get so much of money, 10 lakh, 20 lakh, 25 lakh. I essentially go ahead and close the loan in 4 years. 25 years ka housing loan, I go ahead and close it in 4 years. Okay. Now the question is, HDFC levies a foreclosure penalty. A foreclosure penalty. Okay. Why should it levy a foreclosure penalty? It is getting the money in advance. In spite of that, it is levying a foreclosure penalty. Why is it the case? If you give me the answer to this, you will understand why there is a premium or why there is a premium on early redemption or conversion. Okay. You give the answer to this, automatically your question will get sorted out. Why should HDFC levy a foreclosure penalty? Because HDFC's position is very safe. It got the principal back. In spite of that, it levies a foreclosure penalty. In spite of that, it levies a foreclosure penalty. Why is that the case? You give me the answer to this. What happens is when I go for a foreclosure here, I'm essentially cutting out the income of 21 years. I'm essentially cutting out the income of 21 years that HDFC would otherwise have received if I had to pay the loan at the EMI of 2 lakhs. By choosing to prepay the HDFC loan, I am cutting out the income that HDFC would have earned from me for the next 21 years, part one. Part two, I had set aside funds for this. Now, because the customer repays the full amount within 4 years, I have to ensure that this money starts getting allocated elsewhere. Otherwise, for HDFC, this will be idle money. So HDFC has to again make the efforts to find a prospective customer, a credit-worthy customer. It is making effort to ensure that it reaches the hands of a customer who also will return the money back. So therefore, in 25 years, at the beginning, this activity had to be done once. But because of your prepayment, this activity has to now be done twice. And therefore, HDFC levies a foreclosure penalty, which is exactly the reason why companies will pay a premium for early redemption or conversion of preference shares. The intent is not to receive the principal. See, HDFC is not there to recover the principal. वो उसका काम नहीं है. HDFC is there to recover principal along with interest, and therefore foreclosure penalty is levied. Similarly, here, if you have invested in a company's preference shares, and the company wants to redeem it early, you as the shareholder or as the investor stand to lose the interest you would have earned had the company not opted for early redemption or conversion. And therefore, there is a premium that is attached to it. Okay. So that is the discussion. Why do I have a premium? When in fact it is the cost to the company. It's not a cost to the company. Okay. Early redemption is not a cost, it is a saving. It is a cost to the investor because investor stands to lose the interest. Okay. So therefore, that takes care of your, okay. So that's right. That is absolutely right, Tanisha. Yes. So the company is voluntarily going for an early redemption, which is why it has to pay the premium. Otherwise, the shareholders cannot seek early redemption. Because it is a contractual obligation and a contractual right. The contract says you get the redemption after 20 years, for example. So shareholders cannot go earlier and demand that. HDFC cannot come to you and say, repay it within 15 years. Are you only have signed the loan agreement giving me a 25-year tenure. How can HDFC demand 15 years? Cannot. So similarly, preference shareholders cannot. Okay. All right. So that takes care of that discussion. Now, suppose my preference shares are classified as a liability. Just understand this. I'm not going into computational details. Okay. Preference share with face value of 1,000. Okay. After 20 years, redemption is 1,200. And these preference shares come with a 10% dividend, mandatory every year. And there is a redemption value of 1,200. Now, how the thing happens in financial instruments is, it looks at your outflows, which are important. Sir, outflow matlab, sir, due to this instrument, what is the cash outflow that will happen? Sir, simple na. 10% dividend every year. So 1,000 into 10% means 100 rupees each year for 20 years. And at the end, 1,200. So in the 20th year, your outflow will be 1,200 plus 100, 1,300. And for years 1 to 19, it will be 100 rupees each. It will be 100 rupees each. So what the financial instrument standard tells is you are having years 1 to 19 cash outflow 100 per annum, and year 20 it will be 1200 plus 100, that is equal to 1300. This is your cash outflow. You need to discount it to the present value. You need to discount it to the present value. Sir, कौन सा rate use करोगे? The cost of capital or whatever is there in that company's characteristics. Using that features of the company, you can determine the WACC or the incremental borrowing rate, whatever the financial instrument standard tells you. I'm not going to go into that because that is a separate discussion altogether. So therefore, you take a discount rate and you bring it to your present value. And every year you will start accounting for the finance cost, and the repayment will be taken as a repayment of the liability. Okay. So what earlier you used to do was something like this. I'll tell you what you used to do earlier. Earlier, you used to pass the entry P&L account debit to bank 100 rupees. This would be done for what you can say, this would be done for 19 years. Because this is dividend, it won't go to P&L, it would have gone to preference dividend. Okay. This is what you would have done for 19 years. And then in the 20th year, you would take preference dividend 100, premium on redemption 200, preference share capital 1000, to bank 1300. This was something that you would be doing, and the premium would go to either securities premium or it would be going to the reserves. Okay. This was something which you used to manage at your end. Now, Ind AS does not work like this. Ind AS ऐसा बोलता नहीं है. Ind AS tells you need to discount this to your present value. So discounting factor, whatever rate is there, typically it is the market rate for similar instruments. That is the discount rate. Okay. For financial instruments, you take the market rate of similar instruments and do the discounting. Okay. To arrive at present value. Since you are using the market rate, the present value is essentially nothing but the fair value of this instrument. You are using the market rate because financial assets or liabilities should always be recorded at their fair values. Okay. They will always be there at their fair values. So we do a discounting. Now discounting to kar diya, we arrive at the discounted value. Let us suppose the discounted value is 800 rupees. I don't know what it will be, but I'm presuming it to be 800. So what you are going to do is you will then prepare an amortization table, year 1, 2, 3, etc. till 20. You start with opening. Sir, opening kitna hai? 800. Finance cost at what was the discount rate? That will be your finance cost. It will come here. Okay. Then repayment. The repayment here will be 100, 100, 100, 100, and in the end it will be 1300. Okay. In the end it will be 1300. And then the closing balance. In the end, this will become 0. In the end, this will become 0. So what the financial instrument standard tells is the finance cost is what starts hitting the profit and loss. Your preference div share will be accounted at this value because this is the fair value of the instrument depending on the market rate discounting that you have used and the value of cash outflow. So that is what we have studied. So therefore, the present value of the obligation is nothing but the present value of all the future cash outflows discounted to the present value using a market rate on similar instruments. So therefore, we take it as 800. It will come and sit in my balance sheet at 800. And then you will start accounting for this finance cost in the P&L. The premium will not come separately. The premium will not come separately. And then you have a repayment. The dividends, etc., what you repay is nothing but a repayment of this liability. So you arrive at the closing. Now, this repayment is what I am preponing it. Instead of 20 years, I am preponing it to, let us say, 12 years. 12th year, the company says, I got huge cash, let me repay off my preference shareholders' dues. I will tell them, you forego your interest for years 13 to 20, and I will repay the amount entirely to you right now. So that repayment principle is also nothing but a finance cost. That repayment principle is also nothing but a finance cost. So essentially, when preference shares are classified as a liability, the premium paid. Sir, for Companies Act purposes, whatever you do is not your concern. Whatever you do is not your concern. You are engaging in reporting. So the premium paid, which is usually taken to securities premium. Regardless of conversion or redemption, will always be taken to P&L regarded as finance cost. Is it okay? So, implications for EPS, no adjustments required as already deducted while computing net profit after tax. Okay, as already deducted while computing net profit after tax. तो कुछ नहीं करना है. So preference shares are classified as liability. Do you need to do anything? Answer is no. It's already forming part of finance cost, so you don't have to do anything in this regard. If preference shares are classified as equity, premium paid generally taken to securities premium or retained earnings whether converted or redeemed. So for the purpose of EPS, this is a fund which is not available to the equity shareholder. What did I say yesterday? The very first thing that I discussed is your EPS is computed from the perspective of that equity instrument which is subordinate to all other categories of equity instruments. So because this preference shareholder is getting a premium, that much funds will not be available to the equity shareholder, and therefore this amount, it's not deducted in the profit and loss. That means it is not forming part of net profit after tax. You will have to consider a separate further deduction. implication for EPS. Deduct from net profit to arrive at net profit attributable to equity shareholders as such premium is not deducted while calculating net profit after tax. Are we clear with this? Yes. Are we clear with this? Yes. Anybody has any doubts here? Yes. Clear. What about others? Mohammed, Mansha, Yukta, Shankar, Yadu, Viraj. Today people are in a Sunday mode. Yes. See, this discounting, you don't worry about this right now. Okay. I tried to explain how the treatment happens in financial instruments. You don't have to break your head on this right now. Okay, don't worry about this. This will be dealt with separately under financial instruments. You have not yet studied it. If I start explaining this, I will have to tell the institute, give me another 10 classes. Okay, so I will forget that I explained anything about this today. Okay, just forget it. You will understand this. Okay, you have your entire January month allocated to two major important topics, that is your business combinations, consolidations, and financial instruments. That point of time, you will be studying this. And when you study this, you will understand. Okay, you will understand. Okay, so for the time being, just forget this. Understand that when preference shares are treated as a liability, everything goes to the P&L. Nothing goes to retained earnings or securities premium, including the premium on redemption, because that is the premium which is in the nature of a finance cost. इतना याद करो, इतना काफी है. When you study this financial instruments, you will probably remember me and say that Aditya had explained some 800 rupees, which I did not understand at that time. Now I have understood. Okay. When you study that time, you will get this. Okay. For now, I tried to do it. For some, I was successful. For some, I wasn't, but you don't have to worry. Okay. Anyways, the treatment is clear to everyone. Is the treatment clear to everyone? Anybody has any doubts here? No doubts. Anybody has any doubts? No doubts. Only doubts. All clear? Yes. In days 33 study module 1. Okay, just let me know if you have understood and you have noted it down. Okay. Let me just revisit a couple of old study material. Okay. Yes, there will be sessions for the self-paced modules, but it will be recorded. I just had a discussion yesterday. I think for strategic cost management, right? You're having some SCMP or something like that and corporate laws. So for these particular modules, Institute is coming out with recorded, a snippet will be there, a 1 hour session probably on one topic. Just I'm giving an example. Okay, so suppose you have something like just in time or those lean systems of costing or inventory management. So there you will have a 1 hour clip which is attached and that will be made available to everyone. Okay. So there is something in the pipeline is what I understand. Okay. So I don't know. I'm not sure. They are looking for the faculties and the sessions. It will be happening very soon. Okay. It will be happening very soon. It's not going to be live. It's not going to be like this live. The videos will be there available. It's like something like you get these pen drive sessions and all. So you can do that. Yes. I'm not aware about the procedures, Shankar, whether we can give the self-paced modules before or after the exam. I really don't know. Okay. Because so many changes, it's students who are more well informed than me. You can just have a look at it. Okay. The board of studies will anyways give you the guidance in this regard. I'm not the right person for that. Okay. All right. So let us come to the questions based on this concept. Okay. Let us come to the questions based on this concept. I'll open the presentation. Okay. Uh, okay. We have done this. I don't have to explain. We did this. I don't have to explain. Okay. We did question 11 also. Okay. All right. I think we did illustration 5. Good. We saw what is measurement of basic EPS. We saw the rights factor. Hey, we've done quite a number of things. Huh? We did question 12. That's right. I gave you question 13 for homework. That is also right. Okay. So now all that is left is some question with related to rights, etc. Okay, fine. All right. Diluted, I'll come later. Now we looked at some other important concepts. Okay. Yes. Early conversion of preference shares. Okay. Uh, 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 may be induced by an entity through favorable changes to original conversion terms. Excess of fair value is a return to the preference shareholders. Amount is deducted in calculating profit or loss attributable to ordinary equity holders. This is what the standard says. Okay, this is para 17 reproduced as it is. But for the purpose of interpreting para 17, please apply what we have discussed. Okay, what I have discussed is I have gone one step further and given the discussion that whether it is going to be a financial liability or an equity and accordingly how the treatment will happen. So please refer the notes. Okay, refer notes for further interpretation. You will get this, don't worry. But for further interpretation, please remember to refer the notes. Okay. All right. Fine. That is done. Okay. Fine. We come to this question, illustration 2. Okay. This is there in your study module. This is the question where you are going to have confusion if you do not have the revised study module. Okay. So just be a little alert. Just be a little alert and you'll come to know. Okay. An entity has the following preference shares in issue at the end of 20x4. 5% redeemable non-cumulative preference shares. 5% redeemable non-cumulative preference shares. These are classified as liabilities. What are they classified as? Liabilities. The question is giving to you that it is a liability. That means what? That means any dividend that has gone would form part of finance cost. You don't have to deduct it separately. You don't have to deduct it separately. During the year, a dividend was paid on the 5% preference shares amounting to 1 lakh. Ignore for EPS as finance cost forms part of net profit after tax. They have given the profit after tax for the year is 1,50,000. So this 1 lakh is already deducted in arriving at 1,50,000. So therefore, don't break your head, ignore this. Okay. Next, increasing rate, cumulative, non-redeemable preference shares issued at a discount with a cumulative dividend from 20x5 of 10%. We saw yesterday that 7% discount example, share of 100 rupees issued at 81.63. You go on accumulating it to 100 in the form of discount for the first 3 years, and fourth year onwards, there will be a 7% dividend on that. So that was the treatment. So now, how do I do the treatment of that? The shares were issued at a discount to compensate the holders because dividend payments will not commence until 20x5. Matlab 5 years, there is no dividend payment that happens. To compensate the shareholders, I am issuing the shares at a loss. I am issuing the shares at a discount. The accrual for the discount in the current year calculated using the effective interest method. That discount rate of 7% in our example was the EIR. So here also the same method is being used. Using the effective interest method amounted to 18,000 rupees. Now this discount would ideally go and form part of my retained earnings directly. It would not hit the profit and loss account because it is your discount on equity shares. See, any transactions that I have with equity shareholders will never hit the profit and loss account. Payment of dividend, payment of premium, premium on buyback. Any transaction, put it in your mind, any transactions with owners of the entity will never hit the profit and loss account. It will always go to retained earnings. Sir, why is that so? Because they are owners. They are not outsiders. Okay. If they are not outsiders, payments made to them can never come to the profit and loss account. Never. Okay. Because they are providers of capital. So when they provide capital, the return that goes to them cannot be regarded as a profit and loss item. It will be regarded as a P&L appropriation item or an item of reserves. So therefore, this discount of 18,000 would not have gone to the P&L because it is related to a non-redeemable preference share. And a non-redeemable preference share will always be an equity item. Will always be an equity item. And therefore, this discount is issued to providers of capital. It would not go to the P&L and therefore it has to be considered separately. These shares are classified as equity 2 lakh. 2 lakh is the value. Discount is 18,000. 18,000 will be considered. 18,000 will be considered. Okay. So that takes care of number 2. 8% non-redeemable, non-cumulative preference shares. At the beginning of the year, the entity had 1 lakh 8% preference shares outstanding. But at 30th of June, it repurchased 50,000 of these at a discount of 1,000. It repurchased 50,000. That means it paid 49,000, but it got back shares of rupees 50,000. So there is a discount of 1,000. There is a discount of 1,000. These are non-redeemable, non-cumulative. That means what? It is in the nature of equity. It is in the nature of equity. But when you buy this back, the discount that you have earned, see, you have paid 49,000 to buy back something worth 50,000. So you have paid 1,000 less. You have paid 1,000 less. So for you, it is a profit. For you, it is a profit. What entry am I passing? Sir, own preference shares debit. I'm just writing a simple account name for us to understand. Own preference shares debit 50,000 to bank 49,000. So I am left with a surplus of 1,000. This surplus of 1,000 cannot go to the profit and loss account because this instrument is a non-redeemable, non-cumulative instrument, and therefore this instrument ends up going to your profit and loss, and ends up going to your items of equity, and therefore we have to consider it separately. You have to consider it separately. So you will add 1,000. It is a benefit for you. It is a benefit for you. Are we clear with this? Yes. Are we clear with this? So therefore you will consider this item also. So first one we consider, second one we consider, third one, 7% cumulative convertible preference shares converted in the year. These shares were classified as equity already until their conversion into ordinary shares at the beginning of the year. No dividend was accrued in respect of the year, although the previous year's dividend was paid immediately prior to conversion. Okay. To induce conversion, the terms of conversion of the 7% convertible preference shares were also amended. And the revised terms entitled the preference shareholders to an additional 100 ordinary shares on conversion with a fair value of 300. So, I am giving a benefit on early conversion. I am giving a benefit on early conversion in the form of 100 equity shares at rupees 300. 100 equity shares at rupees 300, that is rupees 30,000. Is this a benefit I am giving to my equity shareholders? Answer is yes. Are these shares classified as equity or liabilities? Sir, these are classified as equity. If these are classified as equity, the premium that I am paying on their early conversion, would it have gone to the P&L? Answer is no. Where would it have gone? It would have gone against the retained earnings, the other equity item. So if it has gone against other equity item, this 30,000 rupees represents a fund, represents an amount, represents a sum, represents a figure which is not available to the shareholders. Sir, which shareholders? The equity shareholders. Sir, which class of equity shareholders? That class of equity shareholders which is subordinate to all other equities, to all other equity instruments forming part of the capital structure. उसको ये 30,000 नहीं मिलेगा, मालूम है. I know that it will not get this 30,000, but this 30,000 has not gone to net profit after tax. It would have gone and adjusted against other equity. Therefore, we need to deduct this separately. Therefore, we need to deduct this separately. Is it okay? So, determine the adjustments for the purpose of calculating EPS. There are three adjustments, sir. We start with 1,50,000. We will be deducting 18,000. We will be adding 1,000 and we will be deducting 30,000. We will be deducting 30,000. Is it okay? It will go to other equity. It will go to other equity. To other equity. Okay. It goes to your retained earnings or whatever it is. Okay. Or whatever it is. Okay. So that is where it will go. Are we clear with this? Yes. So I start with 1,50,000. I will deduct 18,000. I will add 1,000. I will deduct 30,000 and you will get your answer. Okay. So if you look at the study module, it is exactly what we have discussed. 1,50,000 minus 18,000, you agree. plus 1,000 you agree, minus 30,000 also you agree. These items are all going under other equity, but actually they represent monies which are not available for your ultimate shareholder. In 1,000 rupees scenario, it is going to be available. Okay. But the remaining two will not be available. So I have to deduct it. They do not form part of P&L. Not part of P&L. That is why I have to deduct it separately. That is why I have to deduct it separately. So 1,50,000 becomes 1,03,000. Is it okay? Yes. So this is the treatment. Those of you who are having the earlier study module, you can see out of 1,50,000 only 18 and 1,000 was adjusted. 30,000 is not adjusted. 30,000 is not adjusted, which in my opinion was not right. This solution is right as per the standard also. This solution is correct. The institute has made this change. So those of you not having this module, please ensure you make this particular change in the answer. Okay, you make this change in the answer. Are we clear with this? Yes. Did you understand? Did you follow? Is there any correction? Is there any doubt? Is there any clarification required? Yukta, Tanisha, Yedu, Viraj, Shankar, Mohammed, yes, Mansha, Badri, Vishal, tell me, any doubts so far? Clear, sir. Sir, why was 30,000 not, see now, that was not right. Okay, now why it was not deducted? I will have to make up an assumption and tell you don't consider that. Okay, if you see the previous batch sessions, of mine, I'll show you. Okay. Okay. Same thing is written here. No further adjustment is needed. Okay. When I was doing the previous class, I had told specifically, it may be in one of the batches, I may have written it, that institute does it this way. Okay. But that was technically not right as per the standard. Okay. So this is right. We stick to this. Okay. Forget, see, if this is wrong, it's wrong. That's it. Okay. So institute has rectified it, which is good. So therefore, we take the rectified solution and move forward. All right. So that sorts out question number 2 for us, and illustration 2 is done. Okay. What is there in illustration 1? Okay. Question is big. Solution is of 2 lines. Okay. ABC Limited issues 9% preference shares with fair value 10 each on 1st April. Total value is 10 lakhs. Shares are issued for 5 years, would be redeemed at the end of 5th year. The shares are to be redeemed at 11 each. At the end of year 3, that is on 31st March X4, company finds that it has earned good returns than expected over last 3 years and can make the redemption early. To compensate the shareholders for 2 years of dividend which they need to forego, the company decided to redeem the shares at rupees 12 each instead of the original agreement of rupees 11. Okay. It is giving a premium on early redemption. Comment on the impact of early conversion of preference shares at a premium on earnings for the year 20X3X4 attributable to ordinary equity holders of ABC Limited for basic EPS. Ignore the EIR impact, that is effective interest rate impact, and answer only on the basis of Ind AS 33 only, and answer only on the basis of Ind AS 33. So what you are going to do is 1 lakh rupees will be deducted while arriving at the net profit attributable to equity shareholders, because this amount would go and sit in your securities premium. Okay. They have added a small line to this question. They have said ignore the applicability of financial instrument standards. Further, additional payment to be made can be met from securities premium as a premium on redemption. It will go to securities premium or reserves. It will not go to the profit and loss account, because what you are doing is an early conversion. What you are doing is an early conversion. Okay? So therefore, comment on the impact of early conversion. You are going to deduct it separately, because this would not form a part of net profit after tax. Okay? So that takes care of illustration 1. ये भी आएगा नहीं आपके डिस्कशन के लिए, but still it's just there, so we did it. Okay, so that takes care of most of our questions. Now I want you, one second, let me see what is left out for us. This is done. Increasing rate preference shares, repurchase of preference shares at a premium. It is a charge to retained earnings. Amount is deducted, so this is nothing great. We have already seen this. Okay. All right. Illustration 1, 2, measurement of basic EPS. All of this is done. Okay. 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 Contingently issuable shares is for Tuesday. That's right. So let me just see what I can give you. Okay. All right. I want you to do illustration 4 for homework. Company issued 10 lakh ordinary shares fully paid by way of capitalization of reserves, means bonus. Okay. So try illustration 4 for homework. You can try this also for homework. It is a simple rights issue question. You should be in a position to also do this question for homework. It is a rights issue question. This also you should be able to do it for homework. Are you okay to do these questions? Yes. I do not want to do this because it's going to be a repetition of the same. So can I trust that you will do these questions? Yes. It's right shares, yeah. It's nothing different. Okay. I have done right shares in great detail already. Okay. Me doing this question will only give you, will only spend more time on doing something which you already know. Okay. So please try this out. Question number, whatever I have marked for you for homework. Okay. Yes. All right. Good. So with that, we conclude our discussion on basic EPS, and we now come to diluted EPS. We now come to something known as, okay, 1 minute. Before diluted, I think I'll do one more concept, a fresh concept, so that that's not related to diluted EPS. Okay. That's related to participating shares. Okay. All right. Participating preference shares. This is appendix to Ind AS 33. Appendix to Ind AS 33. Okay. Very simple concept, not something which requires a great deal of your mental efforts. Okay. Let me see where the question is first, because I want to do it with the help of a question. Okay. Okay. Fine. We pick up illustration 15. Okay. I have given the sequence. We will see this sequence later on. Okay. First, we will understand with the help of the question. An entity has two classes of share in issue. 5,000 non-convertible preference shares and 10,000 ordinary shares. Okay. The preference shares are entitled to a fixed dividend of 5 rupees per share before any dividends are paid on the ordinary shares. Ordinary dividends are then paid in which the preference shareholders do not participate. Okay. Now, each preference share then participates in any additional ordinary dividend above rupees 2 at a rate of 50% of any additional dividend payable on an ordinary share. The entity's profit for the year is rupees 1 lakh. Dividends of 2 rupees per share are declared on the ordinary shares. Compute the allocation of earnings for the purpose of calculation of basic EPS when an entity has ordinary shares and participating equity share instruments that are not convertible into ordinary shares. Okay. So now let us understand the question, what the question is talking about. We are having two instruments. One is non-convertible preference shares and one is ordinary shares. Now, EPS is always going to be computed from the perspective of the ordinary shares. EPS is always going to be computed from the perspective of the ordinary shareholders. Okay. What it is saying is, from the available profit, the first thing that will go is preference dividend, 5 rupees per share. Okay. Then you will have something that will be distributed to equity shareholders. See, ideally, once the preference shareholders get their dividend, they are out of the game. But in this case, in this type of instruments, once you are going to determine the dividend that will be paid to the ordinary shareholders, there will still be some profit which is left. In that profit, the preference shareholders also are going to have a share. Ideally, net profit after tax minus preference dividend, giving you net profit attributable to equity shareholders. Nobody participates in this. But in this case, in the net profit that would have been normally attributable to equity shareholders, the preference shareholders are participating in that. And therefore, we have to do an adjustment. We have to do an adjustment to remove them because the EPS is from the perspective of that equity holder which is subordinate to all other equity instruments in the capital structure. Okay. So now with that in mind, let us see how to solve this particular question. Okay. So first we take the profits before dividend. Okay. That is how much? 1 lakh. Less first preference dividend. Preference dividend. Okay. 5,000 shares. So 5 5s are 25. 25,000. Less equity dividend. 2 into 10,000 shares. They have given that equity dividend is deductible at is going to be levied at 2 rupees per share. So 1 lakh minus 25 minus 20, that leaves you with 55,000 rupees. We call this as undistributed profit. Undistributed profit. Ideally, this undistributed profit would be attributable entirely to the equity shareholders. Would be attributable entirely to the equity shareholders. In which case, for my EPS, I would just deduct 1 lakh and deduct 25,000 and then do the computation. But in this case, the preference shareholders are also having their stake in this. They are also having their stake in this. So the question is, how do I determine? How do I determine my EPS? How do I determine my EPS? Okay. So now let us try to do it with the help of simultaneous equations. Okay, or simultaneous solving. Okay. So now, assuming that rupees 55,000 is notionally distributed, comma, let the share of dividend for each ordinary share be X. Let it be X. And then if you look at the question, each preference share then participates in any additional dividend above rupees 2. That means that 55,000 is the notional distribution which is above 2 rupees per equity share. And that is at a rate of 50% of any additional dividend payable on the ordinary share. It is at the rate of 50%. So if the ordinary share gets X, therefore allocation to each preference share equals to half of it at 50%. So 0.5x, 0.5x. Therefore, number of equity shares is how much? 10,000. So 10,000x plus number of preference shares is how much? 5,000 preference shares multiplied by 0.5x. This is assuming that entire profits are going to get distributed. So when I solve this, x will come to 4.4. X will come to 4.4. Okay, you can solve it and check. X will come to 4.4. Therefore, when I talk about EPS, particulars, equity share, preference share. Now, distributed profits. Profits already distributed, it is rupees 2 and here it is rupees 5. Here it is rupees 5. Undistributed. Sir, in the case of undistributed, it is rupees 4.4 for equity, 2.20 for preference. Basic EPS will be how much? 2 plus 4, 6.4 and 7.20. This will be your reported EPS number. This will be your reported EPS number. You can cross check multiplied by number of shares. This is 10,000 and this is 5,000. So this gives you 64,000 and this gives you 36,000. Total together is rupees 1 lakh, which is exactly what we started out with. Okay. So my EPS number that will be determined will be a combination of EPS on distributed profits and EPS on undistributed profits. Sir, why do I need to do it like this? Because the preference shares are having a share in my 55,000 worth of undistributed profits, and therefore we have chosen this particular presentation. Okay, we have chosen this particular manner of solving. We assume that the undistributed profits are also distributed, in which case we can identify how much will go to the preference shareholder. We can identify how much will go to the preference shares, and accordingly we shall do the computation to determine how much exclusively belongs to the equity shareholder, and then we consider that as your EPS. Are we clear with this? Yes. Are we clear with this? Anybody has any doubts, any difficulties in respect of participating preference shares? Yes. Let me know. Okay. What about the others? Yadu, Shruti. Shruti is there or not? Others, Mohammed. Nobody is reverting. Sunday mode. Good, sir. Okay. Fine. Understood. All right. So that's it. So we'll go through the theory for this once. How do I compute? First step, calculate undistributed profits, which is nothing but net profit minus preference dividend minus equity dividend. Find allocation per share, per equity share and per preference share if all undistributed profits were to be distributed. Generally, allocation per equity is taken as X. Based on a sharing, preference shareholder is taken, is also based on sharing ratio. Allocation to preference shares is computed. In our case, okay, 0.5. Formulate the linear equation. Total undistributed profits is number of equity into allocation per equity share. In our example, 10,000x plus number of preference shares. In our example, 5,000 multiplied by allocation per preference share 0.5x. So that is 2,500x. EPS would need to be separately calculated for equity as well as the participating preference shares. Therefore, EPS is equal to distributed dividend per share plus share in undistributed profits per share. So that takes care of your EPS would need to be separately calculated. Are we clear with this? Practically, it happens. That is why this particular concept is there. Yes. You could be having it in some of the companies. Yes. So that is why you have this scenario. So that takes care of participating preference shares. Question 15 is done. Question 16, same thing, only figures are different. So do this for homework. Okay, do this for your homework. Are we clear with this? यस, ठीक है। So we are almost kind of done with our basic EPS. Participating also done. Now we start with diluted EPS. Now we start with diluted EPS. Yeah. Now we start with diluted EPS. Okay, कहाँ पे यार? Yeah. Okay. You want to start it off now or you want to start it off after a break? Let me know. You want to do this right now or you want to do this after a break? Okay. मेरे बोलने से पहले सबने बता दिया. We take a 10-minute break. We will resume at 9. Okay, we will resume at 9. It's 8:46. No problem. Take a 15-minute break. आज Sunday है. Yes, we will resume at 9. Okay. This is not a new concept. This is something you've already done in your inter, but it will kind of refresh your memories. Okay. After the break, we resume at 9. ठीक है? All right. Break. I got your message, Suraj. Yes, new student. I got your message. I don't know why you are facing a difficulty. Okay. All right. So coming to our next discussion on diluted EPS. Okay. So the accounting standard does not stop at giving only basic EPS. Basic means the EPS that is shared depending on the profits already earned, depending on the capital structure already there. That is what your basic EPS talks about. It is a past figure. It is a past figure. It is not a present figure. And therefore, your basic EPS has relevance, no doubt, but not a great relevance because it is pertaining to the past. So, in fact, we are told that accountants live in the past, right? But in DS 33 and AS 20 also for that matter, spoke about something known as a diluted EPS. Something known as a diluted EPS. Sir, what is a dilute? What do you mean by diluted EPS? This is a forward-looking EPS figure. Sir, forward-looking, matlab, are you predicting the future? In some manner, yes. In some manner, yes. So there may be certain instruments in our capital structure which are capable of getting converted to equity in the future. These could be certain convertible instruments. These could be the presence of certain options or warrants which will get exercised, or these could be certain ordinary shares which are issued upon satisfaction of specified conditions. They represent potential equity shares. They represent what? They represent potential equity shares. Potential in the sense, today they are not issued as equity, but in the future, they may be issued as equity shares. And when they are issued as equity shares in the future, there may be an impact on the earnings per share. And therefore, what will be that impact in the future on account of a potential ordinary share being converted into an ordinary share is what diluted EPS is all about. So when I say potential ordinary share or potential equity share, it is a financial instrument or other contract that may entitle its holders to ordinary shares. That may entitle its holder to ordinary shares. Example, convertible preference shares, debentures, options and warrants, contingently issued shares. There may be other types also. Okay. So these are my diluted EPS shares which are going to be considered. In basic EPS, we considered actual equity shares. हमें कन्वर्जन नॉन कन्वर्जन होगा नहीं होगा उससे कुछ फर्क नहीं पड़ता था. We would look at the status as on the date and we would do the computation. The presence of potential shares did not have much significance until they were actually converted. Now, when I talk about diluted means a reduced impact. Diluted means a reduced impact, a decrease or reduction in the amount. So a diluted EPS essentially involves a reduction in EPS or an increase in loss per share इसको हम लोग बोलते हैं dilution. We call the activity as dilution. We call the EPS as diluted EPS. Whereas anti-dilution means what? Anti means its opposite. It is either an increase in EPS or it is a reduction in loss per share. As accountants, I always was telling you conservatism is not so important, but at some places you do have conservatism which is put in. So therefore, if you are having potential shares which give the impact of a reduced EPS or an increased loss per share, you report such number as your diluted EPS. If the presence of potential shares does not dilute the EPS, but rather it anti-dilutes it, then do not report that. So this anti-dilution is essentially not reportable, whereas the diluted impact is what is reportable. ठीक है? So इसको हम लोग बोलते हैं dilution. All right. It is a future, a forward-looking EPS, a forward-looking EPS number. Okay. Now, how do I compute the EPS? Well, it will be computed as adjusted net profit or loss for the period attributable to equity shareholders. So we start with the net profit, then we do the adjustments for dilution divided by adjusted weighted average number of equity shares outstanding during the period. So basically the numerator denominator is the same except for these words. It was net profit attributable, now it will be adjusted net profit attributable. It was weighted average, now it will be adjusted weighted average. Components of diluted EPS, general situation, profit or loss attributable to ordinary equity holders of the parent entity. If there is a profit or loss from discontinuing operations, you will disclose two numbers of EPS. One is profit or loss attributable to the ordinary equity holders of the parent entity, that is both continuing and discontinuing together. So you will present the first number for total operations and the second one you will present it for continuing operations. You will not present discontinuing operations separately because it carries no meaning. It is no longer going to be continued. So you will present total operations and continuing operations separately. Are we okay with this? Yes. So what are the steps? Step 1, determine dilutive potential ordinary shares. Step 2, compute adjusted profit or loss. Step 3, compute adjusted weighted average. Divide step 2 by step 3 and you will get your diluted EPS. Okay. So that is a very simple calculation that is explained. We will look at diluted EPS with the help of illustrations, additional questions which I have shared, which will be a revision of what you have done in your intern. Okay. So now let us come back to diluted EPS. Okay. Now, this sheet comes with a disclaimer, a big disclaimer. Okay. Please ignore the applicability of financial instruments in these questions. Today's date, you don't know financial instruments. You are yet to study. For you, the disclaimer may not appear significant. But in January, when you study financial instruments and then you come to EPS and you see the way we have solved it, you will end up asking, sir, financial instruments we studied that way. Here it is not considered like that. So here my focus is not on confusing you with financial instruments. My focus is on making you comfortable with EPS. Once the financial instruments are done, you yourself will be able to do the adjustments and get the right answer. Okay. All right. Now, question 15. Okay. Let us look at some of these questions. These are straightforward questions, not something which you have already done. So I don't have to explain much in this. Okay. All right. For the purpose of computing diluted EPS, what should be assumed as the exercisable price of options that are exercisable at a price which is not fixed? For example, in a case where it is known that an option to be exercised is at a price between 45 to 55, what exercise price would be used for computing the diluted EPS? Okay. This should be 45. Okay. See, You are looking from the perspective of dilution. Dilution means the entity's worst case scenario. The entity's worst case scenario means the instrument holder's best case scenario. So you are going to look at an issue price which is most advantageous from the standpoint of the holder. The computation assumes the most advantageous conversion rate from the standpoint of the holder. And therefore, in the exercise price range between 45 to 55, the most advantageous price to the customer, to the holder, is 45 rupees per share. Hence, 45 would be considered as the exercise price. Is it okay? Yes. So that is just a simple, what you can say, a simple principle that is given in the form of a question. Okay. All right. Now, let us come to the next one. Darbhanga Limited gives you the following information to compute diluted EPS. You are given net profit 2 crores. Number of equity shares outstanding 40 lakhs. Basic EPS 2 crore by 40 lakhs. They only computed and gave 5 rupees. Number of 11% convertible debentures of rupees 100 each, 50,000. Each debenture is convertible to 8 equity shares. So the value of that is 5,50,000. Interest expense, wait. Yeah, sorry, I'm sorry. This is, I think, interest expense is 5,50,000. Tax saving on account of interest expenses 1,65,000. Okay. Number of 11% convertible debentures is 50,000. So now you are required to compute diluted EPS. You are now required to compute diluted EPS. Diluted EPS means what? Sir, diluted EPS means you start with the basic EPS. Due to the presence of financial instruments which give rise to equity, you will compute another EPS number. Now, if that potential ordinary share conversion gives rise to any change in the income or expense, you will have to include such income or expense also. And therefore, in the given question, you will not only consider 2 crore, you will also consider the impact of the interest expense, which will end up getting saved in the future. Are we okay with this? Yes. So therefore, the interest what you would have paid will no longer be paid because you are converting. But because you are converting, you are saving on interest. That means your profits are going up. That means income tax will start hitting you. And therefore, your what you can say, your impact is going to be saving of interest minus the tax impact thereon, because you are going to pay extra tax on account of increased profits. You are going to pay extra tax on account of increased profits. So I give you 2 minutes. Quickly get me the diluted EPS answer. Okay. Let me see. Quick. Yes. No answer. Why isn't anybody reverting? Everybody slept off, huh? छोड़ो सर संडे है. Okay. So your basic EPS starts with 2 crores. Weighted average is 40 lakhs. So basic EPS was 5. The dilution impact is going to be 3,85,000. How 3,85,000? Sir, you are going to save interest 5,50,000. But because of saving in interest, you will end up paying additional tax. So therefore, your net saving will be 3,85,000. Adjustment on dilution, your equity shares, your 50,000 debentures will be converted to 8 equity shares each. So 50,000 into 8, 4 lakhs. So therefore, the adjusted EPS or diluted EPS is going to be 2 crore plus 3,85,000 divided by 44 lakh. Those of you who got 4.63, excellent. Excellent. Okay. So Tanisha is right. Muhammad is right. Shankar is right. Yes, absolutely. Okay. All of you got this part right. So the standard procedure, what you should follow is you start with basic, do the dilution adjustments, add the basic plus dilution to arrive at the total working for diluted EPS. In all the questions, I have tried to stick to that particular format so that it remains clear for you. Okay, it remains clear for you. Okay, am I too fast or would you prefer me to physically solve these questions? Or is it okay the way we are doing it? Yes, is it okay? This is what you have, what you know. So that is why I have thought I'll keep it this way. Because in the previous batches, I was trying to solve it, but in a 3-day session, completing the standard would become a Herculean task. So this time I thought, let me run through the sheet myself. And hopefully that will ease out the pressure on solving. But I hope you people are able to follow. Okay. All right. This way is fine. Okay. All right. So now coming to question 17. While calculating diluted EPS, effect is given to all dilutive potential ordinary shares that were outstanding during that period. Gyan Batra is just giving some knowledge. Take it and keep it. Okay, it's not having any significance. Your question starts from here. Calculate diluted EPS from the following information. Net profit for the year 85 lakh 50. Number of equity shares 20 lakhs. Number of convertible debentures 1 lakh. Interest expense 6 lakhs. Tax relating to that is 30%. Same question, only figures are different. So basic 85 lakh 50, 20 lakh number of equity shares, 4.275 is your basic EPS. Adjustment for dilution, number of profit figure, well, 6 lakh into 70%. Because the tax, it will be, the saving will be net of tax. So 6 lakh into 70%, 4 lakh 20,000. Acha. Coming to the 8% convertible debentures. Okay. This is a trick. This is a adjustment which you have to make out by yourselves. Many times what will happen, students will take 1 lakh into 10, 10 lakh. Now see, you are having 8% convertible debentures of rupees 100 each. That means 1 lakh. So ideally 1 lakh into 8% into 100. So that gives you how much? 100 into 8%, 8 into 1 lakh. It should have been 8 lakhs. Your interest should have been 8 lakhs. But it is only 6 lakhs. Sir, ये तो printing error, ये printing error नहीं है. This is not a printing error. This is the fact, this is the clue that the debentures have been issued during the year. They are not there right from the beginning. They are not there right from the beginning. Sir, अपने को कैसे मालूम? Well, rupees 6 lakhs is what is the interest that is charged, whereas 8 lakhs is what should have been the interest. So 6 divided by 8, that gives you how much? I think that gives you 3 by 4 multiplied by 12. So that is a period of 9 months. That means the debentures have been issued and are in existence for a period of 9 months only. And that is why when I do my weighted average number of equity shares, I take it for a period of 9 months. So 1 lakh into 10 into 9 by 12, 7 lakh 50,000. So therefore, your total adjusted EPS will be 85 lakh 50 plus 4 lakh. Why this is different? Okay, this is just a typo error. Solution is correct, but when I wrote the answer, this is a typo error. 85 lakh 50 plus 4 lakh 70 gives you 89 lakh 70,000. 89 lakh 70,000. Okay. Divided by 27 lakh 50, you get 3.26. You do get 3.26. Okay. Are we okay with this? Yes. Anybody has any doubts so far? Question 17. Yes, sir. No, sir. All clear, sir. That's right. The diluted EPS is correct. Okay. Yeah. Everybody understood question 17? Anybody has any doubts? Question 17. Okay. That's right. Nothing is there in this. Okay. So 16, 15, 16, 17. Okay. 18. Now it starts getting not complicated, but they are putting in bonus shares and then diluted potential, all that is there. So we'll see one by one. Okay. Calculate basic and diluted EPS of Meghna Limited from the following. Okay. Number of equity shares, rupees 10 each, as at the beginning of the financial year, 50 lakhs. Net profit, 2 crores. Okay. Number of shares of 10 each issued for cash on 1st July. This is a fresh issue. Issue of bonus shares on 1st October, 1:5 as at the beginning of the year. That is 10 lakh shares. Convertible debentures outstanding at beginning of the year, 10% debentures for rupees 1 crore. Conversion ratio, 1 share for 1 convertible debenture. Company's tax rate is 40%. Okay. So now let us start with the working. Yes. First thing, you are required to calculate the basic and then the diluted. So वैसे ही करेंगे. So at the beginning of the year, now we compute the weighted average number of equity shares, 50 lakhs. So 50 lakhs were there in force for entire 12 months. So 50 lakhs. Next, you come out with a fresh issue on 1st July. That is 10 lakh shares for 9 months. So that is 7 lakh 50,000. And then you come with bonus shares of 1:5 as at the beginning of the year. That means on 50 lakhs, not on 60 lakhs. Okay. It is on the opening balance. The new issue is not entitled to bonus shares. It is the opening shares. So that is 50 lakhs into in the ratio 1 is to 5. So you will be having 10 lakh shares. These are obviously deemed to be there for the entire reporting period. So 10 lakhs. So 67 lakh 50,000. 67 lakh 50,000 is your weighted average number of equity shares outstanding during the period. Okay. Now the basic EPS 2 crore. Weighted average number is 67 lakh 50. So basic EPS is 2.96. Adjustment for dilution. Sir, I am issuing debentures. I have issued debentures which were already there from the beginning of the year worth rupees 1 crore. So therefore, if this gets converted, I will end up saving this interest. So 1 crore into 10% into 60%. Net of tax, your saving is 6 lakhs. And the number of shares that you are having is how much? Sir, the number of shares is going to be 1 crore is typically 1 lakh. Okay. Because we take it as the 100 rupees. So therefore 1 lakh into 100. So that is 100 lakh or 1 crore. So 1 lakh multiplied by 10 multiplied by 1 second. Wait. One share for one convertible debenture. Okay. You're not given the conversion price. Okay. Now, all right. To make a correction here, make this as 10 shares for one convertible debenture. 10 shares for one convertible debenture and assume this price to be rupees 100. Then you will fall in the place because here you will get 1 lakh debentures if I am not wrong. 1 lakh debentures and then the corresponding shares is going to be 1 lakh into 10, that is 10 lakhs. So 6 lakh saved, 10 lakh extra weighted average number. So 2.06 divided by 77 lakh 50. So your diluted EPS is 2.66. Your diluted EPS is 2.66. Okay. So that takes care. Every time you do a diluted EPS computation, you have to check it with the basic. It should always be less. It should always be less. If it is not less, you will not report that as the diluted EPS. You will not report that as the diluted EPS. Are we clear with this? Yes. Are we clear with this? Yes or no? All right. I will be leaving this for homework. You can go through it. Better to skip some questions because they are going to get repetitive. Okay. This is important. This question is important. We had received, we had a similar question in one of your exams where you were given multiple, what you can say, you were given multiple potential equity shares and you had to select a combination at the least diluted. Okay, so that is why this question is important. From the following information of Bhadrachalam Limited, determine the order in which dilutive potential shares should be considered in computation of diluted EPS. Net profit attributable to equity shareholders 1.5 crores. Number of equity shares outstanding during the year 25 lakhs. Average value of one equity share during the year rupees 100. Details of potential equity shares. You are having options 1,20,000 with exercise price of 75. You are having convertible preference shares 10 lakh shares entitled to a dividend of 8 per share. Conversion ratio is 4 equity shares for every preference share held. And then you have 15% convertible debentures of rupees 100 each at 12 lakhs. Each debenture is entitled for 2 equity shares. Assume corporate tax rate is 30%, dividend distribution tax rate is 10%. Is it okay? Yes, is it okay? Understood the question? So let us look at the answer. We have to look at the order in which the diluted potential equity shares shall be considered. That means when you do, see, I am having basic EPS plus 3 instruments, 1, 2, 3. So the question says, what combination will give the least dilution? What combination will give the today office, sir? Why is there office today? Today is a Sunday now. Yes, that is why I have kept my sessions more on Saturday and Sunday. So I get to spend more and more time with you. Okay. All right. You can watch it later. Okay. Okay. So now the question is asking, in what order will you consider the dilution? See, it is possible that basic plus the first potential share gives some dilution. It is possible that basic plus the second gives a further dilution. So basic plus 1 plus 2. It is also possible that basic plus 1 plus 2 plus 3 gives you a further dilution. Or it could be an anti-dilution. Or it could be a single dilution. Or it could be 2 dilutions. Or it could be 1 and 3 together. So it could be any permutation and combination which could give the maximum possible dilution. Your job is to give the maximum dilution in the EPS working. Your job is to give the maximum dilution in the EPS working. So therefore, how do I do that? The standard has given us the standard has given us a mechanism where I can identify how do I go about with the dilution. How do I go about with recognizing the dilution? So we will first look at the potential equity shares in isolation. We will look at it individually. We will not club it with, we will not be clubbing it with the regular basic EPS and all. We will look at it on a standalone basis. So I am having three potential equity shares. One is options, one is convertible preference shares, and the third one is convertible debentures. The third one is convertible debentures. So now options. When the option is exercised, what am I going to get? Sir, when the option is exercised, you are going to get money. But will I get any income? Will I have any income? Answer is no. So therefore, additional net profit is 0. Additional net profit is 0. But because of the option getting exercised, are you getting the money? Answer is yes. Are you getting money as the what you can say? Are you getting the money as per the fair value, or is it an issue below the fair value? Sir, it is an issue below the fair value. आपको कैसे पता? How do you know? Well, if you look at the case, options have an exercise price of 75, whereas fair value is 100. So have you made the issue at 75? Answer is no. You have done it at 100. And therefore, There is a bonus component to this. There is a bonus component to this. So that bonus component is going to be 1,20,000. That means this 1,20,000 multiplied by, you are collecting 75, but the corresponding equivalent will be taken as 100. So 1,20,000 into 100 minus 75 divided by 100. So that gives you 30,000 shares. That gives you 30,000 shares. Are you okay with this? Yes. Are you okay with this? So 30,000 represents bonus. It represents bonus. Is it okay? Yes. Is it okay? So this represents your bonus. So that is what is going to come here. So 30,000. So 0 divided by 30,000, your earnings per incremental share is going to be 0. Is going to be 0. Next, convertible preference shares. Convertible preference shares. This one you are going to have. You are going to have additional net profit. You are going to have additional net profit. How do I determine that? Sir, convertible preference shares entitled to a dividend of 8 rupees per share cumulated. So 10 lakh into 8. 8 lakh plus 10% thereon, 88 lakhs. And additional number of shares, this is going to be 10 lakhs multiplied by 4 equity shares. So 10 lakh my 4, 40 lakhs. So 88 by 40, 2.20. And finally, when you talk about convertible debentures, this is going to be 1.26 crores. Yes, additional net profit will be the debenture net of tax saving. The debenture interest net of tax saving. Then additional number of equity shares, you will be having 12 lakh 2 equity shares. So 12 into 2, 24. So therefore, it will come to 5.25. Okay, it will come to 5.25. Is it okay? Yes. So therefore, number of shares issuable under option is equal to 1,20,000 into 100. So this is basically this. Okay. So now look at the earnings per incremental share. One is 0, one is 2.2, one is 5.5. Which one am I going to give priority to? Sir, you have to give priority to options, because in the case of options, the incremental value is nothing, it is 0. The next one in the ladder is convertible preference share. It is 2.2. And in the last case, it is 5.25. It is 5.25. So this goes as 3. So when I do the adjusted EPS or diluted EPS calculation, we are going to move step by step. We are going to move step by step to see the impact. Okay. So let us look at the impact. Net profit as given 1.5 crores. Am I given 1.5 crores? Yes. All right. Now, number of equity shares outstanding, well, that is 25 lakhs. So 1.5 divided by 25 lakhs, 6. This is your basic EPS. This is your basic EPS. Next, add adjustment for options. This is no change in earnings, but increase in number of shares, 30,000. So therefore, after options adjustment, 1.5 plus 25.3, I will get earnings per share of 5.93. Check, is it lower than 6? Answer is yes. So this becomes diluted. This becomes diluted. It is lower. Coming to the next one, preference shares adjustment. Preference shares adjustment. Okay. So now 88 lakhs is there. Yes, this is the profit attributable to shareholders. We had only computed that 88 lakhs. Okay. Next, number of equity shares 40 lakhs. Number of equity shares 40 lakhs. So that gives you 1.5 plus 0.88, 2.38, 65.30, 3.64, 3.64. This is again a dilutive impact. This is again a dilutive impact. But next one is after debentures adjustment, profit attributable 3.64, 65 plus 24, 89.3, 4.08. Now you look here, this ends up being anti-dilutive. Your share earnings is increasing in this case, is increasing. It should not. So therefore, you restrict your answer to 3.64. You restrict your answer to 3.64. Are we clear with this? So my basic EPS is 6, diluted EPS is 3.64. Any doubts? Yes? Have you understood this? Did you try to understand any doubts in this? So you have to first identify which instrument you will include first. Assign the ranking depending on the incremental profitability. And once that is decided, we will incorporate it. Okay, we will incorporate it in the regular EPS workings. So your first task is compute the instrument, look at its dilution on itself, and then give the ranking. The results of that ranking will be incorporated in the EPS workings on a total basis. Yes. See, the whole point is a bonus element is going to give you cash. That cash is a future element, true, but it is resulting in a cash flow which I cannot predict. But the bonus component is a free element in my structure. The debenture conversion shares is a free element in my structure. The preference conversion element is a free element which is there in my structure. We cannot consider the total option value because this option does not give this total as an option does not give what you can say if I talk about options, the total bonus plus what is coming in cash is not exactly dilutive because what is coming in cash is ultimately going to be apportioned on a time basis. And that is why we consider only the bonus element because the bonus alone has the potential equity share. The other one has a cash inflow that happens and therefore it does not remain a potential share. Are we able to follow? Yes, are we able to follow? Yes. Options only the bonus elements will come. Okay, nothing else. All right. I want you to try question 21 right now. I want you to try question 21 right now. Take a good 10 minutes and try to get it. Don't look at the answer. Try to do question 21 right now. Yes. A diluted EPS working, we consider those shares which are automatically getting converted to equity without any extraneous action, like a cash inflow that is required. A cash flow that is required cannot be a potential share. If that be the case, then you can come out with umpteen potential shares because there is always a possibility of coming out with a fresh issue in the future. That is why in the case of options, we will not be considering uh, we will consider only the bonus element. We will not consider the shares at fair value. Okay. All right. How many of you got the answer to question 21? Right, right. So after the diluted EPS, today we complete diluted EPS and see the presentation. Then I leave you with some questions from the Institute for homework. And then on Tuesday, we do contingently issuable shares and some 2, 3 questions related to financial instruments. And then we are done with the chapter. Okay. So Tuesday, I don't see a long class. Today will be a slightly long class where we are almost on good speed to complete the diluted EPS. All right. Yes, yes. Not so simple, pretty complicated, right? Yes. Any answers? How many of you got the basic EPS for X0, X1? Okay, good. So Shankar has given the basic EPS answer. That's right. Okay. All right. So let us run through the solution. Uh, Basic EPS for X0, X1. You are having fully paid equity shares, 1 lakh. So that is part of your gains. You are having partly paid equity shares of 10 each, 5 paid up. So that is basically 50,000. So total gains is 1,50,000. Bonus shares. The company issued on 1st January one bonus share for 8 shares held on that date. So 2 lakhs divided by 8, 25,000 is your bonus. So 1,75,000. Add, you are having convertible debentures. You are having convertible debentures. So on that also there will be a bonus, and on the preference share also there will be a bonus. But for the purpose of basic EPS, we don't consider convertible debentures or convertible preference shares. For the purpose of bonus, for the purpose of basic EPS, your weighted average is going to be 1,75,000. So the reported EPS is going to be 10 lakh divided by 1,50,000. So that will be 6.67. That is going to be 6.67. Are we okay with this? Are you okay with this part of the answer? Yes. Anybody has any doubts here? Anybody has any doubts? The bonus has come in the next year. So the reported EPS is going to be 6.67. For the year X1, X2, bonus has already come in. So it is going to be 10 lakhs divided by 2 lakhs, that is 5. That is 5. And adjusted basic EPS 10 lakh divided by 1 lakh 75,000, 5.71. How many of you had gotten the basic EPS and adjusted EPS right? Tell me. How many of you had got these parts correct? Yes? You have to go step by step. There is no other option. Okay, there are too many things happening in the question. So you have to do it step by step. Yukta, did you get this right? Shruti is not there today. Shruti, did you get this right? Muhammad, Shankar, Yadu, Viraj, Manoj got it right. Very good. Okay. Yes, all the three. Very good, Shankar. Very good. Okay. What about ladies in the group? Yes. Yadu, basic you got. See, it's always a pleasure to be among all of you. Okay, for me, Saturdays and Sundays, I get to spend extra time with you because there is no hanging sort of an office on my head. Okay, so that is why for me, spending time on Saturday and Sunday is not really a pain, it's a pleasure. But I spoil your Sundays, but you have no option. First two got correct. Okay, fine, fine. Good, good, good. All right. Okay, fine. Coming to the next one. See, I'm having certain potential equity shares in the capital structure. What are they? Sir, first one is I'm having options. Second one, I'm having convertible preference shares. Third one, I'm having convertible debentures. Now, which one to select for the purpose of reporting? Do I select one? Do I select one and two? Do I select one, two, and three? Do I select two and three? Do I select one and three? All this will come from the incremental EPS analysis. All of this will come from the incremental EPS analysis. So in the case of options, you won't get any additional profit. So that is going to be zero. But you are going to get additional number of equity shares. You are going to get additional number of equity shares. How are you going to determine additional equity shares? 10,000 into 75 minus 60 by 75. Okay. So you are having the fair value as 75, but you are issuing it for 60. Okay. So 10,000 into 60 divided by 75, that will be the number of shares at fair value. But you issued 10,000, so the difference is going to be your bonus component. It is going to be your bonus component, which you are considering. That gives you earnings per incremental share, which is 0. In the second case, preference dividend and number of equity shares. 1,60,000. So that gives you 5. Then finally, convertible debentures, 84,000, 40,000 shares, 2.1. So in this case, the first option goes for options. The second one is for convertible debentures, and the third one is for convertible preferentials. Are we okay with this? Yes. Are we okay with this? So with this background, we will then proceed to start with the dilutive antidilutive calculation. Once the basic is done, you will first consider this, then you will consider this one, and finally you will consider the preference capital conversion. Okay, so net profit, add adjustment for options, add adjustment for debentures, add adjustment for preference share. Okay, so all of this is going to give you your impacts. The last one is reducing the decline. That means it is in fact increasing the EPS. So therefore, this is antidilutive. Anti-dilutive. Will not consider that. So therefore, what am I going to consider? I will be considering only this 4.06, 4.48. That's about it. Are we clear with this? Yes. Yeah. All right. So that takes care of this question. I want you to try 22 for homework. Okay. Yes. And with that, we are kind of done with the dilution questions of the past. Now we look at what is there in the dilution. See, let us then come to our institute's questions. Okay. This one also was institute only, but these are not in the study module. These are taken from past papers, intermediate. Okay. Most of it is taken from there. Coming to the current set of questions, illustration 7. Yeah. So now we consider this. See, when I do diluted EPS, I will not only consider the profitability impact, I will consider all other impacts associated with the dilution. Like for example, because of change in profitability, management bonus may change. Because of management bonus changing, your tax impacts will change. So therefore, there is a whole set of consequences that you will have to adjust to arrive at a reasonable representation of the diluted EPS figure. So in this case, you can just have a look. I'll quickly run through the answer itself. Okay. Illustration 4, 5, 6. Okay. Entity A has in issue 25,000 4% debentures with a nominal value of ₹1. That means ₹25,000 debentures. The debentures are convertible to ordinary shares at a rate of 1:1 at any time until 20x9. The entity's management receives a bonus based on 1% profit before tax. So there is a management bonus associated. A's results for 20x2 showed a profit before tax of 80,000, profit after tax of 64,000. For simplicity, tax rate of 20% is assumed. Calculate earnings for the purpose of diluted EPS. Okay. So now, for the purpose of diluted EPS, how am I going to proceed? My profit after tax is 64,000. Because of dilution, the interest cost is going to get saved. So 25,000 into 4%, 1,000. Because of this, my tax impact will increase because my profit has increased. So minus 200. Because of this 1,000 reduction in interest, my management bonus also increases. So 1,000 into 1%, that will be 10. And because of the increase in management bonus, my tax benefit also will be lower because the profits are lower on account of higher management bonus, and therefore you are seeing a positive impact on the tax benefit. So therefore, earnings for the purpose of diluted EPS is 64,792. Are we clear with this question? Yes, are we clear with this? So simple question it is, nothing is there. You don't only consider the interest, you also consider the further impact that this potential instrument is going to create. And all those impacts together uh, will form part of the earnings for the purpose of diluted EPS. Okay. Interest reduced adds the profit, increases tax. Management bonus increases, so it reduces the profit. Tax benefit reduces, so it increases the profit. Okay, so that takes care of this illustration number 7. Okay, quick. We have done this question. We have done question 16, question 17, question 18. Okay, all right. I want you to try this today for homework. It is the incremental EPS. Calculate basic EPS, earnings per incremental share for convertible bonds and diluted EPS. Nothing new. Okay. I want you to do this question also for homework. This I have given you for homework. Please try it out. Sequence for computing diluted EPS. I have given the steps. For each potential step, you determine additional net profit, additional dilutive potential shares, giving me the EPS per incremental ordinary shares. Step 1 by step 2. Rank it based on step 3 above. First rank is given for least earnings per incremental ordinary shares and so on in an ascending order. And then compute the diluted EPS. Okay. So this is the manner in which you determine the sequence. Okay. So this one, I think we did this. So question 20. I think we also did 21. Yes. So determining the sequence for computing diluted EPS in the case of options, we consider only the free or bonus element present in the option. That's it. Okay. So how do you calculate the free element? Shares issued on exercise of options minus number of options into exercise price divided by market average price. Okay. So simple, no difficulty in this. Yes. So that is all about diluted EPS. I have given this for homework. Please try it out. Okay. This is also simple diluted EPS. Please try that out. Okay. So that is done. Next one is the options. This also you can do for homework. I don't have much to say. I'm leaving you with a lot of homework questions in the hope that you will try these questions. In the hope that you will try these questions. Okay, this is a RTP question. Try it out. Yes. And then this one is also an RTP question. Ordinary average shares, number of shares under option. Try this out. Yes. Yeah. So that leaves you with a good number of questions to try out today. Okay. Because I have put many things in that particular aspect. Okay. Now, this question is important. This question is slightly important. Let us solve this together. Okay. Illustration 9. Okay. All right. Please read this question. This is important. Okay. What all I have given you for homework, though they are important, that is something we've already done. So you don't have any problem in that. Please try. At 30th June, the issued share capital consisted of 15 lakh ordinary shares of rupee 1 each. On 1st October X1, the entity issued rupees 12 lakh 50,000 of 8% convertible loan stock for cash at par. Each rupees 100 nominal of the loan stock may be converted at any time during the years X6 to X9 into the number of ordinary shares set out below. By 30th June, you can convert 135. By 30th June, X7 130, 125, and 120. If the loan stocks are not converted by X9, they would be redeemed at par. This illustration assumes that the written equity conversion option is accounted for as a derivative liability. It is a derivative liability and mark to market through profit or loss. The change in the options fair value reported in X2 and X3 amounted to losses of 2,500 and 2,650 respectively. It is assumed there are no tax consequences arising from these losses. The profit before interest, fair value movements, and taxation for the year around 30th June and X2 and X3 amounted to 8 lakh 25, 8 lakh 95 respectively and relate wholly to continuing operations. The rate of tax for both periods is 33%. Calculate basic and diluted EPS. This is an important one. This is an important one. Okay. Now, we will start with basic EPS. Basic EPS. Okay. I am having profit given to me as 8 lakh 25, 8 lakh 95,000. Thirtieth June 20x2, 30th June 20x3. Okay. Net profit before tax and fair value adjustments. How much is that? Sir, 25, 8 lakh 25, 8 lakh 95. Yes. Less. Less interest. Okay. We are having interest. What will be the value of interest? 12 lakh 50,000 into 8% into 9 by 12 for the first year and 12 by 12 for the second year. Into 8% into 9 by 12. And this will be 12 lakh 50,000 into 8%. So that comes to 1 lakh 75,000. So this comes to 7,50,000, 7,95,000. Net profit before tax and before tax. Fair value adjustment. What is my tax rate? The rate of tax is 33%. So profit after tax. So that gives me 7,50,000, 5,02,500, and 532, 650 less fair value loss. Acha, these are financial instrument contracts. That is what they have given to us. Which contracts? The return equity conversion option. So because they are financial instrument contracts, they are accounted as a derivative liability and it must always be fair value. So therefore, the movement is 2,500 loss for X2 and 2,650 for X3. Okay, so 2,500 and here it is 2,650. 5 lakhs. Yes, and this is 5,30,000. Yes, divided by weighted average number. So that comes to 15 lakhs for both because this is basic EPS. ₹15 lakh shares. All right. So basic EPS comes to rupees 1, and this is per share. This fair value movement is essentially, see, each 100, this particular statement that you are seeing is a derivative, okay? A derivative liability, because the entity is under an option to deliver its own equity instruments. The entity is under an option to deliver its own equity instruments at variable prices. If it is due to passage of time, 135, 130, 125, 120, so on and so forth. So it is under an obligation to deliver its own equity instruments, and therefore it has been classified as a derivative liability. Okay, as a derivative liability. because it is at a derivative liability stage, we treat it as accounted at fair value under financial instruments. Why? That is the requirement under Ind AS 109. Again, I am saying you will study it later. So that is why you are going to do the accounting of that fair value movement here. The fair value movement is given to you to be 2,500 and 2,650. The question has given that it is assumed that there are no tax consequences arising from these losses. That means we cannot claim these losses in our tax returns. That is what it means. And that is why we have not considered it in the net profit before tax. It is considered in the net profit after tax. This is essentially movement in fair value, 2,500, 2,650, which we are taking in the reporting. Is it okay? Yes. The fair value options otherwise could be allowable if it is suppose a minimum alternative tax where you are following Ind AS and you have to pay tax under book profit. Probably it would be allowed. I'm not much of a tax expert. Okay. But yeah, it could be allowed under minimum alternative tax probably. Okay. So that is how you are going to treat this. Is it okay? Yes. Anybody has any doubts? No doubts? Yes. So basic EPS is done. Basic EPS is done. Any doubts in basic EPS? Anybody? Anybody has any doubts in basic EPS? If no doubts, then we proceed further. Okay, I presume there are no doubts. Okay, all right. So this is basic. Coming to diluted, see, we are having multiple conversion ratios. 120 shares, 125 shares, 130 shares, 135 shares. Yes. So a nominal loan stock of 100 can be converted into any of these number of shares. So therefore, what we have assumed is we will go for maximum possible dilution. Maximum possible dilution. That should be the way we solve. So our conversion ratio for maximum dilution is going to be 135 ordinary shares. Is going to be 135 ordinary shares on 30th June 20x6. Okay. So how many loan stock are having? 12,500. That is 12,50,000 divided by 100 into 135. So that comes to how much? 16 lakhs 87,500 equity shares. So this is what is our assumption. We assume that maximum possible dilution happens, and that is why we take the maximum conversion ratio. Is it okay? Have you understood? So now when I proceed to solve, let us solve with the help of the basic EPS workings only. See, in all the cases, whenever I have done the diluted EPS, I have always done with the starting point as basic EPS. So that comes to 20x1 x2. Diluted EPS is equal to C. 5 lakh profit. So we start with 5 lakhs plus plus 75,000 interest. I'll save with a tax component of 33% plus the option gets converted into equity. So now there will not be any fair value movement. So potentially the option gets converted. So potentially this movement of fair value also will not happen. Will not happen. Okay. Okay. Divided by 15 lakh shares plus you have taken this as 1687,500. 1687,500 multiplied by 9 by 12. Why have I taken 9 by 12? Because this is issued on 1st October 20x1. So only for a period of 9 months in year 1. So this comes to, if you do it, you are going to get 0.20 per share. Next. Okay. Okay. 5,30,000 again. Plus 75,000, not 75, 1 lakh. Plus divided by plus 16 rupees. Is it lower than 0.3533? Answer is yes. So we continue to report this as our diluted number. We continue to report this as our diluted number. Are we clear with this? Yes. Yes. Have you understood? Have you understood? Yes. Have you guys understood? See, now the potential shares are getting converted to actual. In my diluted EPS calculation, the options get exercised, and because the options get exercised, your shares are increasing by 1687,500. Because they are increasing by 1687,500, it means the option is no longer an option. The option life cycle has ended. Option के बदले में shares आके बैठ गए हैं. Instead of option, the shares have come and sat, and I never do a fair value measurement of my own equity. That is why the fair valuation impacts are added. There it was subtracted. Here it is getting added. Here it is getting added. Are we okay with this? Yes. Are we okay? मनोज समझा आपको? Denominator of x2, x3, what is there? 15 lakh shares. And then 1687,500 into 12 by 12. It is there for the full year. Now, the options that you had, we are assuming they will get exercised because it is a potential share. We are looking at a diluted EPS. So if you have understood the first denominator, second denominator is just an extension of that. Only thing is, it is for the entire year. The options were introduced in the first year in between. In the second year, they were already there. That is why multiplied by 12 by 12. 15 lakh is the usual denominator that you have for your basic. Manoj, you understood 2,500 and 2,650? Yes? Okay, so Manoj has confirmed. Mohammed, is your query sorted out? Okay, all right. So that takes care of this illustration 9. Okay, all right. Written put options, we will do it later. Okay, presentation of EPS, we have seen it. Okay, all right. This one also I can pull it out. Participating, we completed. Okay, now. Okay. Unfortunately, I will have to leave some questions in EPS because you still are yet to get the knowledge of financial instruments, holding and subsidiary together. So my advice would be we will try to discuss whatever I can in the Tuesday's class, which is pertaining exclusively to Ind AS 33. We are in a position to complete about 90% of the chapter. The 10% contains impacts of financial instruments, contains impacts of business combination and consolidation. It's just 10%. So I will want you to go through those problems, which I will not be doing it this time. Once you complete the topics on business combination, consolidation, and financial instruments. Because otherwise I have to go and start doing that, which will take a lot of time. Okay. So that is okay. So we have almost come to the end of the program of the chapter. My advice, do the homework questions. Do the homework questions. On Monday, we are going to discuss a very important question, that is contingently issuable shares. That important question, I will discuss it first and finish it off in your next class on Tuesday. Okay. On Tuesday's class, we will be doing that first, followed by whatever small things are left. I will not be in a position to finish because you still have a couple of chapters pending for your study. So once that is done, you can go through that chapter and solve the remaining questions in EPS. Okay. That time, if you still have any doubts, I'm still available. Because in February, I think I'll be having a couple of sessions with you. So at that point of time, you can definitely ask me your doubts on Ind AS 33 also. Okay. So will you do these homework problems for me? Yes. Will you do these homework problems for me? Try to do this set also. Okay, try to do this set also. Can you try these homework questions for me and confirm on Monday that you got all of them correct? Yes, please, please, can you do this? Yep. Okay, so please try these questions. Shankar, Mohammed, girls are not there. Yukta, Shruti left in between. Shailesh, Viraj, okay. Yado confirmed. Okay. So do these questions. I think today's class more or less was it clear to everyone? Was it clear? Did you people find it too hurried, too fast, or too slow? Or the pace was fine, the explanation was fine? Was it fine for you guys? Yes, because we are spending 3 to 4 hours on weekends. Was it helpful for you? Yes. Okay, if it was good, I'm happy. If you have any suggestions, even you are free to criticize me and say, sir, you are not at all teaching well. Okay, you don't have to sit here and give only a positive feedback. We are there to improve our methods for you. We are there to improve the delivery. We are there to do the things the way you would want because ultimately we cater to your success alone. Okay. So if there is any change that you want, please let me know. If there is any improvement, you want more questions to be solved, okay, let me know. I hurried up only because the questions were similar to what you have already done in your intermediate. Okay, that is why I just took the liberty of going a little fast. But if you have not understood, that is a different story. Okay. Let me know on Tuesday whether all the questions are clear. You have today, you have Tuesday, Monday to go through. Okay. And once that is done, Tuesday, we have one or two very important questions. And after that, I think we will close the session. Okay. All right, guys. Thank you and see you on Tuesday. Okay. See you guys on Tuesday. Bye bye. Study well. Don't come without revising. Okay? There's no option but to revise. Okay. All right. Chalo. Bye bye. Take care. Thanks, Shankar. Sir, session concluded.